Welcome to the Indiana Public Retirement System presents the Pre-Retirement Webinar. This presentation is intended for members of the Public Employees Retirement Fund as well as the Teachers Retirement Fund. A little history on the Indiana Public Retirement System. Our agency was created in 2011 when legislation was passed to integrate the management of the Public Employees Retirement Fund with the Teachers Retirement Fund. Together, we became the Indiana Public Retirement System, also known as INPERS. We manage approximately $42.4 billion in assets, and that is as of June 30, 2022. INPERS is among the largest 100 pension funds in the United States. And we issue payments to more than 160,000 individuals each month. That's more than $3 billion annually. The Teachers Retirement Fund was created in 1921, while the Public Employees Retirement Fund came along in 1945. A little background on who participates in our plan. Combined, we have more than 517,000 members from more than 1,300 public employers. The state of Indiana is our largest employer, but we also have members who are working with our cities, towns, and our counties. Public school corporations have members of both the Public Employees and the Teachers Retirement Fund. And we also have a few reporting hospitals and universities. On the right-hand side of this slide, you'll find all of the funds we manage. So in addition to PERF and TURF, we also manage benefits for the 1977 Police Officers and Firefighters Plan, Judges Retirement System, State Excise, Gaming Agent, Gaming Control Officer, and Conservation Enforcement Officers, as well as prosecuting attorneys and legislators. The Public Employees and Teachers Retirement Funds are very similar, which is why this presentation is for both plans. If you have service in both plans, please know that you'll have the decision on whether you want to retire as a public employee or as a teacher. INPERS will be sure to combine your two accounts at retirement. When we go through this presentation, it is my hope that you're going to gain a better understanding of your retirement benefit plan and become more familiar with the options you'll have to choose from when it's time to complete your retirement application. Speaking of the application, we'll talk near the end of the presentation about how and when you can apply for your retirement benefits. The first question you must ask yourself, though, is which plan are you in? So the Indiana Public Retirement System's PERF and TURF both have two options to save for retirement. The first is the hybrid plan, and the hybrid plan offers two parts to that retirement benefit. One part is known as the defined benefit, more commonly referred to as the pension. And for the pension, you must earn 10 years of service to become vested and eligible for that benefit. The second part is the defined contribution account. This is the account you're always vested in, so you don't need to earn any certain number of years of service to qualify for your defined contribution balance. The other retirement plan offered to our members is the My Choice Retirement Savings Plan. This is more like a defined contribution account or a savings account. There is no pension benefit available for My Choice participants. The defined contribution account is made up of two types of contributions. One type is known as the fixed or mandatory contribution. And that, again, you're always 100% vested and eligible for any contribution that was made as a fixed mandatory contribution. The other type is the variable rate. And just like that sounds, it can change from one fiscal year to the next. And the variable rate is the part you're working to vest in. Full vesting is at 5 years of service. The My Choice Retirement Savings Plan is the newer of the two plans we offer. We began offering that to our public employees in July of 2013, and in July of 2019, it became available to our teachers. We're going to begin with the My Choice Retirement Savings Plan. So if you are a participant or considering participation in this plan, you're going to learn all the details in this section. The My Choice plan structure. So again, two types of contributions are posted to your account. The fixed mandatory contribution is 3% of your gross earnings. And that 3% contribution always belongs to you. So again, you're fully vested from day one in the fixed contribution. NPERS does not offer any loans or hardship withdrawals. In most cases, the only way to access this balance is with a separation of service. Though there is one exception to that rule, and we will talk about that in just a moment. The other contribution type is the variable rate contribution. This is funded by the employer, and the amount received is determined by the number of years of participation. So on our next slide, we have the variable rate contribution vesting schedule. You do need to complete a full year of service to be eligible for 20% of the variable rate contribution. It is a graduated vesting schedule, so you must complete the next full year to increase the percentage you're eligible for. That percentage does increase by 20% per year earned. Again, maxes out at year 5 when you are 100% eligible for all contributions in your account. When you are ready to begin taking distribution, you will have several options to choose from. If you would like, you can purchase an annuity. To purchase an annuity, you must be at least age 62 and have earned 5 years of service. You can purchase an annuity, which we currently offer through MetLife, to create a fixed monthly payment for the rest of your life. You can choose a sole annuity option or survivor benefits as well. The annuity also offers a cash refund or without a cash refund component. And we'll talk in detail about that in our hybrid section of the defined contribution account. You may also choose to take a lump sum distribution. Any lump sum is a one-time payment directly to you, or you can request a partial lump sum. All lump sum distributions do require a 20% withholding for federal taxes. If you would like, we can also withhold your state and county taxes as well. You can roll over to an outside financial institution that accepts taxable contributions. So this would be a traditional IRA or a qualified plan. Examples would include a 401k, a 401a, a 457, a 403b, etc. With any rollover, we do not withhold taxes. That is a tax-deferred option, as taxes are only required when it is a distribution directly to you. And if you are 62 with 5 years and you take a lump sum, a partial lump sum, or a rollover while still working in a covered position, your employer will continue to contribute to this account. The next plan we'll talk in detail about is the hybrid plan. And this is the original plan always offered by the Indiana Public Retirement System to both the public employees and the teachers' retirement funds. The hybrid plan offers several retirement types. 4 of those are listed here on this slide, and we'll talk about the other 2 later in this presentation. The first 2 are disability and survivor. It's my hope that you won't need to take advantage of either of these, but I do think it's important that you have a general understanding of what those are in the event you or a loved one does. So we'll cover those in more detail on the next slide. Our more common types of retirement include the normal retirement benefit, which is paid with a full pension benefit. And we also offer an early retirement option. Early retirement is paid with a reduced pension benefit. So we'll talk today about eligibility for each of these types, as well as the options you'll have to choose from when it's time to complete your retirement application. And those options do apply to both parts of your retirement benefit plan. So you'll choose your pension option and indicate how you would like to take distribution of your defined contribution account. We'll cover those options in this presentation. As mentioned, we're going to talk about disability and survivor in detail. Disability is the only retirement type NPERS offers that a member does not have to be vested. A member needs to earn 5 or more years of creditable service. They must also be deemed disabled by the Social Security Administration. The Social Security Administration will determine the onset date of your disability, and that onset date must occur while you're actively employed in either a PERF or a TURF covered position. The application for disability retirement is the same as it is for an early or a normal, and there is no age requirement for disability retirement. Members who are eligible for disability retirement will receive a full pension benefit so long as they are considered disabled by the Social Security Administration. NPERS will require documentation annually to ensure you are still eligible for that benefit. Another type of retirement is survivor benefits, and this comes up often in conversations when we're talking with individuals who are eligible for their full retirement benefit, but they're not ready to stop working. Their biggest concern: what happens with my pension if I pass away before I apply? If a member passes before starting their retirement benefits, NPERS is required to pay the survivor benefit to their spouse. That assumes they have been married for at least 2 years and the member has earned the minimum 10 years of service. If the member has dependent children, they too could be entitled to a pension benefit so long as they are considered dependent. So let's talk in more detail about the two parts of your plan. Remember, you have the defined benefit, more commonly referred to as the pension, and that's the benefit you'll receive every month for the rest of your life. And the second part, the defined contribution account. This is a cash accumulation balance that you'll be able to take distribution of at the time of retirement. You will apply for both parts within the same application. And as a member of the hybrid plan, you're entitled to both parts. You don't choose if you want the pension or if you want the defined contribution. You are, in fact, entitled to both. Let's talk in detail about the defined benefit. So the defined benefit, again, is a lifetime monthly benefit to you. And that's true no matter your age when the benefit begins, no matter which option you choose, and no matter how long you live. The pension account is funded in full by our 1,300 public employers. Members do not make contributions to their pension account. It is fully funded by the employer. Employers make contributions to a general pension fund rather than to individual pension accounts. Therefore, members do not have a pension balance. And that's why we're going to use a state-defined calculation to determine the amount of each member's pension benefit. We're going to talk about that equation in just a moment, but just know that it will take into consideration your age at the time of retirement, the salary and service you earn throughout your career, and finally, which pension option you choose. As a reminder, full vesting and eligibility for the pension does occur at 10 years. Normal retirement eligibility is available to those members who have earned the minimum 10 years and they're 65 or older. You could earn this full benefit at a younger age by accruing more years of service. So for those members who have earned 15 or more years, they will qualify for a full pension when they are 60 or older. Or you might meet what we call the Rule of 85. The Rule of 85 is for those members who are between the ages of 55 and 59. They can take their age, add to that their years of service. If the sum is 85 or more, the member does qualify for a full pension benefit. It's important to know that your age and service are calculated in both years and months. So a member could be 55 and 6 months and have 29 and a half years of service. Their half year of age plus their half year of service would add together to equal 1 point. The member would qualify for a full pension benefit. Remember, though, the earliest age for normal retirement eligibility is 55. The other retirement type is early retirement. Early retirement is available to those members who are between the ages of 50 and 59, and these members have earned 15 or more years of creditable service. NPERS will calculate your full pension benefit. Then, based on your age at the time that benefit begins, we'll include an age reduction factor. If a member begins their pension at age 50, they'll receive 44% of their full benefit, and they will continue to receive the same 44% every month for the rest of their life. It is possible to increase the percentage or the amount you receive by delaying the start of those payments. For each year of age you delay, the percentage you receive will increase by 5%. Eligibility status, full or reduced. It's important to know if you leave service and you are in a reduced status, you can wait to begin your full benefits until you are age 60 or you meet the Rule of 85. So a member does not have to start their pension as soon as they resign their position. They should begin that benefit when they are comfortable with the amount they will receive. It's also important to note that if you are no longer working in a covered position and you are eligible for full retirement benefits, it is not beneficial for you to delay taking your pension. Many members believe that the longer they wait or the older they are when the benefit begins, the higher that pension amount will be. And that is not true with your NPERS pension. When you leave covered service, your pension amount will be frozen. There are two ways that members can receive their pension benefit without separating from their covered position. One of those is Millie Morgan Retirement. Millie Morgan Retirement is available to those members who are 65 or older and they've earned 20 or more years of creditable service. They can begin receiving their monthly pension while continuing to work in their same covered position. NPERS will not use the additional time earned, though, to calculate any future pension benefit. The other retirement type that allows you to continue working is elected official. Elected official is available to those members who are 55 or older and have earned 20 or more years of creditable service while serving in their elected position. Of course, if the member is younger than 60, they will receive a reduced benefit unless they meet the Rule of 85. Both Millie Morgan and elected official retirements will be effective the first of the month after the member applies. There are no retroactive benefits available to Millie Morgan or elected officials. So now that we've discussed eligibility for each of our retirement types, we're going to learn more about how that pension benefit is calculated. Remember, the pension is funded in full by the employer, and their contributions are posted to a general pension fund. And that's why we're going to use this state-defined calculation to determine the amount of your pension benefit. NPERS will take your final average salary, multiply that by your creditable service, and multiply it by 1.1%. This will calculate an annual pension benefit. Let's break that equation apart and learn more about the details. So for PERF members, your final average salary will be calculated using your 20 highest completed quarters. And those 20 quarters are throughout your entire PERF career. For teachers, we're going to use your 5 highest completed contract years, again, over your entire TERF career. We'll multiply that average by your creditable service and then by 1.1%. So let's talk about how we're earning service. For members of the Public Employees Retirement Fund, you're earning service on a month-by-month basis. You'll earn an entire month by working at least one day in that month. For PERF members who are employed with a school corporation, if you work the entire school term, you'll earn 1 full year of service. And this assumes you were working on the first day of that school year until the last day of the school year. If you do not work the entire year, you will be credited with the number of months you worked in. For teachers, you're earning service on a half year or a full year basis. That half year or full year is determined by the number of days you work in a fiscal year. The fiscal year runs July 1 to June 30. For those members who complete 60 to 119 days, you'll earn a half year of service. For those who work 120 or more days, you're going to earn the full year of service. Members of both the public employees and teachers' retirement funds may also be eligible for leaves of absence. These leaves of absence can be paid or unpaid. Examples would include a maternity leave, paternity leave, adoption, or any other leave that could qualify under Indiana code. We would ask that you call our member advocate team to learn of your eligibility and talk with your payroll department. Any service that can be added for free may allow you to retire earlier, and it will no doubt increase your pension benefit for the rest of your life. If you don't have service that could be added for free, we do offer an option to purchase service. To purchase service, you must have earned at least 1 full year as a PERF or a TERF member. You must also be currently employed in either a PERF or a TERF covered position. That's because we're going to use your current salary to help calculate the cost of your purchase. And you cannot purchase service to become vested. The types of service you can buy include out-of-state, Indiana accredited private school, substitute teaching, although I will say if you have substitute taught in a public school corporation in Indiana, I encourage you to be sure you have the minimum number of days required to be eligible for credit. Remember, half year would be minimum of 60 days. Those 60 days do not have to be consecutive, nor do they have to be with the same employer. Please reach out to our member advocate team to learn more about substitute teaching. If you have military service that does not qualify as a leave of absence, you could purchase up to 2 years as long as you served on active duty for at least 6 months and you received an honorable discharge. Additional service, also known as airtime, does require that you are vested before you're eligible to purchase. Upon vesting, you're eligible to buy 1 year for every 5 years of service you've earned. So immediately, you would be eligible to buy up to 2 years of service. Purchasing service can be very expensive, but it also depends at what point in your career you make that purchase. So I encourage you to utilize the calculators available on our public website and your secure site. The public website is www.in.gov/npers. There you will find a generic service credit calculator. In this calculator, you will enter all information to receive an estimated cost amount. You may also use your secure account at mynpersretirement.org, where it will pull information directly from our system and provide you with a more accurate estimate. If you want to move forward with purchasing service, again, reach out to our member advocate team. They will walk you through that process. You can pay out of pocket. You may make installment payments up to a 5-year period, or you're eligible to roll money over from an outside IRA to make that purchase. While purchasing service can be expensive, it may also allow you to retire at a younger age, and again, it will increase your pension benefit. This slide is going to provide you with examples of what your pension might be. So we've taken the equation to calculate the annual pension, and of course, if you divide that by 12, you can see what you might receive on a monthly basis. And I say might receive because you could increase or even decrease this amount depending on which option you choose. So in these examples, you'll see that as the salary and service increase, as does that monthly pension benefit. The pension, because it's funded by the employer, is taxable income. If you would like, we can withhold taxes for you on a monthly basis. We're able to withhold for federal, state, and/or local county tax. If you have questions about tax withholdings, we encourage you to speak with a tax advisor or the IRS. The application will ask if you would like to have taxes withheld, but please know that you can make adjustments to your withholdings throughout your retirement. Each member will receive a 1099-R from our office every January, and you'll use that to file your taxes. If you would like to calculate an estimated amount of your pension benefit, again, I encourage you to use the generic calculators available on our public website or logging into your account to receive a more accurate estimate on your secure site. We're going to talk now about your defined benefit or the pension options. This is one of the most important decisions you'll make in your retirement. Members should think about, is this money I need to live on, or is it more important that I leave it on to my loved ones? Remember, you will receive this every month for the rest of your life, no matter which option you choose and no matter how long you live. Think about how much income you're going to need in your retirement, and if you need to plan for a beneficiary, how much income will they need and how long will they need that income? So this slide will provide you with the 5 primary pension options as well as an add-on option. Let's talk in detail about each of these pension options, beginning with the 5-year certain and life. So this is the standard calculated amount. If you were to take your final average salary, multiply it by your creditable service, multiplied by 1.1%, that would provide you with the annual benefit for the 5-year certain and life option. This option provides the member that fixed amount for the rest of their life. If the member passes away before they've received 5 years or 60 payments, the remainder of those payments will be distributed to their beneficiaries. Members can name both primary and contingent beneficiaries. If you name a beneficiary, please be sure that you have their name, their social security number, their date of birth, address, and telephone number. That information will be required for each of your beneficiaries. You may name one person or multiple people, a place, or a thing. The second option is straight life, and this is a way to maximize your monthly payment. The member will receive the maximum amount every month for the rest of their life. When the member passes, that payment will stop. NPERS does not make any distributions to a beneficiary with the straight life pension option, no matter how many benefits the member received. So 5-year certain end life and straight life are considered single life options because NPERS is only required to pay the member for the rest of their life. We don't owe anyone else a lifetime benefit. If you would like someone to receive your pension every month for the rest of their life, you'll want to look at our 3 survivor options. The percentage you see is you deciding what percent of your benefit you want your survivor to receive for the rest of their life after you pass away. Members will name one person as their survivor, and that survivor can be anyone. It could be a spouse, it could be a child, a brother, sister. You can name any one person as your survivor. Just know that their age and life expectancy will be used in the calculation of your benefit. If you choose a survivor who is significantly younger than you, your benefit will be reduced, and we may have to eliminate some of the options. If you have a non-spousal survivor, you may not be able to choose the 100%, and oftentimes the 2/3 will not be available. When you complete your retirement application, you will choose one of these 5 options. Please know that at any time during your retirement, you can make a change to your pension option. You can make a change for any reason at any time by calling our office and requesting a new estimate. The most common time a member changes their pension option is if when they retired, they chose a survivor benefit and their survivor predeceases them. In that case, I would encourage you to call our office and request a new estimate. You could name a new survivor, or you could go with the straight life pension option to maximize your monthly payment. The only option that's available just with the first application is the 5-year certain end life. So it is not possible to move from a straight life or a survivor benefit back to the 5-year certain end life. If you choose the 5-year certain end life, though, with the first application, you can change to something different later. The add-on option is known as Social Security Integration. Social Security Integration is available to those members who are starting their pension before they are 62. For those members who are 62 or older, this option will not be available. Social Security Integration does not have any impact on your Social Security benefit. It also does not mean that you are applying for Social Security. NPERS will pay you an increased pension payment every month until you turn 62 if you choose this option. And this option can be combined with any of the first 5 primary options. So you'll receive a higher payment every month until 62. At 62, your pension benefit will be reduced, and it will be reduced by the amount you could receive if you apply for Social Security at 62. There is no requirement that you apply for Social Security at 62, but your pension with NPERS, if you choose this option, will decrease at 62, and it will stay at that decreased amount every month for the rest of your life. We're about to take a look at calculating benefit estimates. We do have an example of a Social Security estimate included, and that should make this option make a little more sense. Please know that Social Security integration is an irrevocable election. In our first sample estimate, we have a member who is 60 years old and they've earned 30 years of service. Their survivor is a spouse who is also 60, and the member has an average salary of $50,000. So when we take their average $50,000 Multiply that by their 30 years of service, which is broken down 15 years of PERF and 15 years of TERF, multiplied by 1.1%, it calculates to an annual unreduced pension of $16,500. This member is entitled to their full benefit because they are 60 with 30 years of service. So the benefit reduction is at 100%. There is no reduction for this member, which is why their annual pension benefit matches the annual unreduced benefit. When we take the 16,500 and we divide that by 12, it will equal $1,375, and that is the amount associated with the 5-year certain and life option. So again, this member will receive that amount every month for the rest of their life. If they pass before they've received it for at least 5 years, the remainder of just those 5 years will be paid to their beneficiaries. You'll notice it is a slightly higher payment, $5.16 more, to receive the straight life benefit, which will provide the member the maximum monthly payment, and when they pass, the benefit will stop. And then the 3 survivor options. The 100% survivor will provide the minimum benefit to the member at $1,242.51. And when they pass, in the far right column, you will see the survivor benefit matches the members that they will receive every month for the rest of their life. The 2/3 option will provide the member a slightly higher payment at $1,285.48. When the member passes, their survivor will receive 2/3 of that amount, which equals $857.42 for the rest of their life. And finally, the 50% option will provide the member the maximum of the 3 survivor options at $1,308.10. When the member passes, their survivor will receive half of that amount, which equals $654.05. In our next example, we've added Social Security integration, because at age 60, this member is eligible to receive a higher pension for the next 2 years. NPERS does require the most recent copy of your Social Security estimate. We will use the age 62 amount to calculate your pension benefit both before and after age 62. So in red, you'll notice that this member's age 62 amount from Social Security is $1,200. Instead of receiving the standard $1,375, this member could choose 5-year certain and life with Social Security integration. They would receive $2,395.20 every month for the next 2 years. When they turn 62, NPERS will take the amount they've been receiving, the $2,395.20, and subtract the $1,200 they could receive if they apply for Social Security. Their new NPERS pension will equal $1,195.20. That will be the amount of their pension benefit for the rest of their life. And that's true, again, whether they apply for Social Security at that time or not. In the next example, we have the same member, but we're going to use a non-spousal survivor who is 25 years old. So as mentioned earlier, the member is not able to choose the 100% survivor or the 2/3 option. They are limited to just that 50% survivor benefit, where the member would receive $1,221.39, and when they pass, their survivor will receive half of that amount, which equals $610.80. $1.70 for the rest of their life. In the final example, we have a member who is 54 and has earned 30 years of service. They have a survivor, again, who is a spouse, the same age of 54, with the same average salary of $50,000. So in this calculation, again, NPERS will take their average salary of $50,000, multiply it by 30 years of creditable service, multiplied by 1.1%, which equals $16,500. In the early retirement reduction row, you will see the member is entitled to 64% of that pension benefit. Because they are not yet 55, they would receive an early reduced payment. So 64% of the $16,500 equals $10,560. If you take the $10,560 and divide that by 12, it will equal $880. That is the amount the member will receive every month for the rest of their life. Let's move over now to the defined contribution account. This account consists of a mandatory 3% contribution. This 3% contribution could be paid by your employer. That would make it a pre-tax contribution. It may also be paid by you, the member, making it a post-tax contribution. Or you and your employer can share the 3% contribution. Each pay period, 3% of your gross earnings is contributed to your defined contribution account. In addition to these mandatory contributions, you may also consider making voluntary contributions. Voluntary contributions are invested in the same account as the mandatory contributions. You'll decide how to invest this account balance. So the mandatory 3% contribution always belongs to you. You're fully vested from day one, meaning you don't have to earn any certain number of years of service to qualify for the 3% contribution and its interest and earnings. NPERS does not offer any loans or hardship withdrawals. Remember, voluntary contributions can only be made on a post-tax basis and can be up to 10% of your gross wages. You'll want to talk with your payroll department if you're looking to make voluntary contributions. There is an exception to the in-service withdrawal rule, and that is Senate Bill 10, which does allow members who are 59 and a half or older and meet normal full retirement eligibility to take in-service withdrawals, whether that be a full or a partial withdrawal. To request any distribution, you will contact our member advocate team toll-free at 1-844-464-6777. You may also request distribution by accessing your secure account online at mynpersretirement.org. With your defined contribution account, the mandatory and voluntary contributions, those are invested by you, the member. We offer several investment options to choose from, some that are risky and some that are more conservative. We have information regarding each of the options we offer available on our public website. There you will find fund fact sheets about each individual allocation option. We do ask that you speak with a financial advisor to learn more about how you should be investing your account. You can change how your account is invested as often as you would like. You can do this by calling our member advocate team or by logging into your secure account. The distribution options on the defined contribution account, you'll want to consider if you need to reduce, eliminate, or prevent debt, Maybe you'll need to have accessibility to cash later for traveling or emergencies. Or you might want to supplement your pension to get the highest possible monthly income you can for the rest of your life. So this slide will provide a list of each of the options we offer, and on the coming slides, we're going to discuss those in detail. We'll begin with the defer payment option. You can defer any distribution from your defined contribution account at the time of retirement. In fact, you can defer until April 1st of the year following your 73rd birthday or leaving employment, whichever is later. That age does adjust to 75 in 2033. That's when you'll need to take the required minimum distribution. NPERS will calculate that percentage, will notify you, and make the required distribution annually. Any balance that is deferred will continue to be invested by you, the member. So you'll want to be sure that you are keeping up with your investment allocation, and be sure to keep your beneficiaries up to date. In case something happens to you, NPERS will pay this balance to the beneficiaries listed on your account. You may also consider a rollover option. A rollover allows you to move your balance from NPERS directly to another plan. This is a tax-deferred option, as taxes are only required to be withheld when this is a distribution directly to you. You can roll this balance to any outside IRA or qualified plan that accepts rollovers. That includes an IRA, which would need to be a traditional IRA, a 401k, 401a, 457, or a 403b. Your plan at NPERS is considered a 401a under the Internal Revenue Code. You'll also want to be sure you have all taxable monies. If you have some non-taxable in your account, you'll want to speak directly to NPERS staff to learn how to take distribution of those monies. The lump sum option is available. You may request a full or a partial lump sum. And again, it is taxable in the year in which it is paid. With any lump sum, NPERS is required to withhold 20% for federal taxes. If you would like, we can also withhold your state and county tax from that distribution. You may also choose to make those taxes up at tax time. If you have post and pre-tax amounts in your account, the distribution will be treated as a pro rata basis. We do ask that you carefully consider tax consequences and future income needs when requesting lump sum distributions. The systematic withdrawal plan is available to our members to allow or create a stream of payments that can be changed at any time. The member will decide the time basis in which they want to receive distributions. So you will select if you would like for us to make a distribution monthly, quarterly, semi-annually, or annually. You may also determine a fixed amount to be paid directly to you. If you would like a fixed amount, you will contact our member advocate team to begin those distributions. The systematic withdrawal plan is designed to deplete the balance by the end of the term selected. You will maintain control over the investments while also receiving distributions. If the time term is scheduled for less than 10 years or 10 years or less, the distribution is required to have a 20% federal tax withholding. If you choose a systematic withdrawal plan for 11 or more years, it will be taxed as regular income. Here is an example of a systematic withdrawal plan. The member has a defined contribution balance of $50,000, and they've requested that we pay them each month for the next 15 years. So their first payment will be their balance of $50,000 divided by the number of payments in that term, which is 180. So their first distribution will equal $277.77. That will be reduced from their total balance, and the remaining balance will continue to be invested. Each distribution will look a little different than the one before it or the one after it due to interest, earnings, and potentially losses. If no alteration is made to the systematic withdrawal plan structure, the balance will be completely paid out after the 180th payment or after 15 years. But please know you can change your systematic withdrawal plan as often as you would like by contacting our member advocate team. Another option that creates a steady income is the annuity. You can buy an annuity, which is currently paid through MetLife. MetLife does offer a straight life or sole survivor annuity option. Again, there is a cash refund and no cash refund option available. So MetLife has been providing our annuity payment since 2018. Because it is paid by MetLife, it will be a separate payment. Though MetLife will allow you to choose what day of the month you would like that payment to occur. They will directly deposit into the same account InPERS deposits your pension. And the annuity payment is subject to taxes, but it is subject to regular income tax. MetLife will allow you to purchase an annuity using all or part of your balance. The minimum purchase is $5,000. With the annuity, we ask that you consider that once chosen, the annuity option cannot be changed, but you also cannot outlive the monthly benefit. There is a single premium fixed income annuity, and once again, you are allowed to annuitize all or part of your balance. The part you purchase the annuity with becomes MetLife's income, and you cannot access that money once you've made the purchase. In general, annuity payout rates are higher for older members than younger, and for larger amounts than lower. Here is an example of an annuity. If you would like, you can create your own estimate by accessing the MetLife Annuity Calculator from either the InPERS public website or through your secure site. Please do not go directly to metlife.com as you may not get the same outcome. So in this example, it was created on June 20th of 2023. And that's important because the market rate will play a role in the amount of your annuity payment. The member has a balance of $50,000. They are 65 and they have a spousal survivor who is 63. With the straight life annuity, without cash refund, the member will receive just over 7.5% return, which equals $313 per month for the rest of their life. And that's true even once the $50,000 has been depleted. When the member passes away, MetLife does not owe any distribution to a beneficiary. Without a cash refund allows the member to receive a higher payment because MetLife will keep any remaining balance. If it's important to leave the remaining balance to your loved ones, you may look at purchasing the annuity with a cash refund. With a cash refund, the member will receive a slightly lower payment, just over 7% return or $294 per month. When the member passes, if there is any balance remaining, that will be paid to their beneficiaries. The member could choose one of the 3 survivor options. It's the same 3 survivor options that are available for the pension. So the member will receive a benefit for the rest of their life. Their survivor will then receive a benefit for the rest of their life. When both have passed, MetLife will look to see, did the member purchase without or with a cash refund? If the member purchased without, when both the member and survivor have passed, the remaining money will stay with MetLife. If the member has named beneficiaries, they will receive the remaining balance. You may also decide to split the balance and do multiple things. So you may consider 25% of the balance paid directly to you as a lump sum. Remembering we are required to withhold 20% for federal taxes, with state and local being optional at the time of distribution. You may defer 25% to keep that invested and access later, and purchase an annuity with the other half. Again, you can split your balance any way you like, and you will choose those options within the application for retirement benefits. NPERS also offers the rollover savings account option. This is where you bring an outside IRA to NPERS. These monies will not be combined with your defined contribution account. It will remain a separate account. And NPERS can only accept taxable monies. You will manage the investments separately. You will maintain beneficiaries separate of your defined contribution account. The rollover savings account does not have any fee. Members are paying a standard $45 per year for their defined contribution account. If you create a rollover savings account, you will not have any additional fees. Speaking of fees, let's talk about understanding the fees that are associated with your defined contribution account. What we see on this slide is a snapshot of a quarterly member statement. Again, each member is paying $45 per year, which is $11.25 per quarter. So this member, the $50,000 fee as a percentage, you can see is much lower than a member who has $100,000 in their account. I encourage you to take a look at your quarterly member statement, whether you've received that in the mail or you view those in your secure account online, to understand the fees you're paying for your defined contribution balance. Other things to consider when reviewing your defined contribution options is that you always compare plan costs. That would include the operating expenses, annual fees, any maintenance fees, etc. Obtain fee schedules in writing and understand why those fees are being charged. Remember that not all fees are bad because you are gaining value and services for paying those fees. Also, keep in mind life expectancy and plan on needing financial resources longer than you may think necessary. The average life expectancy in the United States for women, 81.28 years, and for men, 76.22. Now, this is as of 2019. And for those members who reach age 65, the life expectancy will increase for females more than 85 years and males over 83 years. A staggering statistic we have found is that 34% of defined contribution plan participants who took lump sum distributions reported that sum was depleted within 5 years of that distribution. So be sure if you're going to take a lump sum distribution that you are taking care of those funds so you will have them to access at a later time. Other things you may consider if you're planning to work after retirement is that working full or part-time can increase your monthly income. 72% surveyed prior to retirement said they did plan to work at least some in their retirement. However, only 30% do actually work. If you work after retirement, you may have the ability to delay accessing your defined contribution account and potentially delay the start of your Social Security benefits beyond your full retirement age. Full retirement age with Social Security will pay the 100% benefit. You could receive a reduced payment from Social Security of 70% if you begin those payments at age 62, and that'll increase to 80% if you wait until 64. There is an 8% increase in Social Security benefits each year beyond the full retirement age. It's 24% higher if you wait until age 70. Another note on working after retirement, specifically if you're thinking of coming back to a PERF or TURF covered employer. If you reemploy in a PERF or a TURF covered position before or within the minimum separation period of 30 calendar days, you must notify NPERS. We will void your retirement, your benefits will stop, and if you've already received payments, you will need to repay those to NPERS. Indiana law states if you enter into a reemployment agreement, whether that be formal or informal, prior to your retirement, or even at the same time you file, your account again will be void, your benefits will stop, and you will begin those payments once you do officially resign your position. There is no earnings limitation for reemployment. You can earn a full salary and continue to receive your pension benefit. If you retire and you satisfy all the rules, you can continue to work and receive your pension payment, though no additional benefits will be earned. Finally, you'll want to discuss your plans with your family relating to your retirement. You'll also want to consult a financial planner, tax advisor, or legal expert if you have questions or concerns. It is not required that you do so, but those individuals can be helpful in planning for your retirement. You'll choose a retirement date that fits your goals and begin collecting the documentation you'll need to submit with your retirement application. Speaking of the application, you can apply when you are within 6 months of both your age and service credit eligibility. Please note that it will take NPERS approximately 90 days to calculate, finalize, and begin your pension payments. Ideally, you'll submit an application 3 to 6 months before your retirement date. So you are continuing to earn your regular salary while we're processing your payments and reduce the income gap from your final paycheck to your first pension payment. You may apply by accessing your secure account online at mynpersretirement.org. NPERS no longer accepts paper copies of the application. Members only need to submit this online application. Nothing needs to be signed or notarized. Just simply submit this application through the online portal. If you have questions about registering or accessing your account, locating the application, please contact our member advocate team. Representatives are available Monday through Friday from 8 a.m. until 8 p.m. You may also consider scheduling a one-on-one session. These sessions can be done in person or virtually. We do offer both phone and video appointments. We can accomplish the same things virtually we can in person. If you would like to schedule an in-person appointment, you may contact our member advocate team or use our online scheduler found on our public website. If you're just looking to obtain an estimate, you'll log in at mynpersretirement.org to access the secure site. Remember, this site pulls information directly from our database to provide a more accurate estimate. When you access your online account, you will choose the application and calculators link for those estimates and the application itself. Once you click that link, you'll scroll to the bottom and click Get Started. The application is something that you can start, save your progress, and go back later to finish. Once you've submitted an application, you can still access and modify that application. You could even cancel it entirely. NPERS will notify your employer that you've submitted an application when you are 10 days from your retirement date. That will help to ensure we receive from them all the information we need in a timely manner to get you your benefits as close to on time as we can. This is a cheat sheet to help you determine when you should submit that application. If your retirement date will be January 1st, you'll want to submit before October 1st. That would be 90 days in advance of that retirement date. To determine your retirement date, you will use the first of the month following your last day of work, assuming when you leave covered employment, you are age and service eligible for your retirement type. If you're needing to delay for your age, your retirement date would then be the first of the month after that qualifying birthday. This is information on how to contact us should you need to reach out. We are here and happy to help you 8 to 8 every day. You can call our toll-free number or email our member advocate team. You can use our online resources found on our public website, where you will want to access information like member handbook or forms, the estimators, and scheduling events calendar. I hope that this information has been helpful. You can use other tools such as our social media sites. We do have accounts on Instagram, Facebook, Twitter, and LinkedIn, and we are posting to those sites regularly. We also have our own YouTube channel. If you visit youtube.com and search NPERS, you'll find various podcasts, audio, and video episodes to help you learn more about your retirement benefits. Thank you.